Hi, this is Jane, the Thoughtful Avatar. By popular demand, I am making my first long video, which I reassure you will not be very long. I am not a licensed financial advisor, so this video is just my opinion. I will be discussing why the impact of the war on the US economy will likely not be short-lived. So the first thing to know is that we are running a government deficit of almost 6% of GDP. This deficit, meaning that the government is overspending, is what makes the economy hum and the companies register large profits and liquidity. However, much like an ordinary household, when you spend more than your income, you need someone to lend you money. In the case of our government, it is the people buying our treasury bills and bonds. Our government debt is almost 125% of GDP, growing 8% year on year. A growth of 8% means that if everyone holding US treasuries kept reinvesting repayments and interest into treasuries, we would still require investors to invest an additional 4% every year to sustain it. All things being equal, that would be quite a rosy scenario for their liquidity and profit growth. Currently, the holders of US treasuries are about 75% domestic and 25% international. The main domestic investors are the Fed, Social Security, pension funds, banks, and of course, ordinary investors. On the international front, the main players are Japan and China, with the UK and offshore locations being the main conduits for other international investors from Europe, the GCC, and others. So, let's look at the long-term impact of this war. Even if it stopped tomorrow, the supply of oil would not increase immediately. Qatar, for example, recently said it would take it about 3 years to rebuild the damaged facilities. There would be massive reconstruction spending in the region, and there would also be massive military spending, if only to replenish the stocks of weapons that have been used. With the elevated price of oil putting a damper on revenue growth and profits, I doubt that domestic investors will have the liquidity needed to sustain debt growth at the current levels. To make matters worse, government spending will increase due to military spending and interest rates rising to keep up with inflation. This means that the debt itself will increase by more than last year's 8%, leading to more need for liquidity. So, can we count on international governments and investors to carry the additional weight? Doubtful. China has recently been decreasing its levels of US Treasury investment. As other countries are eager for their companies to participate in reconstruction, they will likely decrease their allocation to treasuries in order to finance such spending. The GCC countries, which have been massive investors in the USA, will probably have to curtail their investments in favor of domestic spending. How the story ends is anyone's guess. It depends on a number of factors I can't control or predict, such as the US monetary policy, any change in its fiscal policy, and the reaction of investors. If they decide to abandon the stock market in large numbers, for example, it would create an influx of liquidity into treasuries. Bottom line, be ready for anything.